How to manage risk in a volatile market? Welcome back to the Plan Future Insight. What a thoughtful question. Managing risk in volatile markets is exactly what separates successful investors from those who panic. Let me share my 20-year playbook for this very situation. First, let's understand today's context. The India VIX is at 17.2, still in an elevated caution zone. The Nifty 50 PE ratio is near 20.26, near its long-term fair value. This tells us the market isn't in a bubble. The volatility is more about sentiment. Mid and small caps are leading today, which signals higher risk appetite but also higher potential for sharp moves. Now, what's likely next? Based on patterns from past cycles, volatility with choppy moves is likely to continue near term. This is normal. This is not a crash environment, but a consolidation phase. Markets are digesting past gains, which is healthy. Here is where it gets interesting. The biggest risk isn't market volatility. It's your own behavior. The urge to stop your systematic plans during a dip destroys more wealth than any bear market. So, here is your framework. First, asset allocation is your anchor. Your equity to debt ratio should be based on your goal timeline, not market noise. If your goal is over 10 years away, stay with your planned equity allocation. Volatility is your friend. It lets your systematic plan buy more units at lower prices. A simple calculation shows a 10,000 rupee monthly systematic investment, with 12% growth, can create significant wealth over 15 years. Stopping that plan can cut the final value by 30 to 40%. Second, consider your regular mutual fund plan with a trusted distributor as your financial bodyguard. They prevent the number one mistake, stopping plans or redeeming in panic. Their experience is your emotional circuit breaker. If you feel anxious, call them before making any decision. Third, systematic investing is your volatility vaccine. It automatically buys more when prices fall, a mathematical advantage. If you have a lump sum, use a systematic transfer plan from a liquid fund to avoid the risk of bad timing. Fourth, rebalance strategically, not based on market timing. If a rally pushes your equity allocation above target, systematically book partial profits and move to debt. Do this every 6 to 12 months. Fifth, upgrade quality. In volatile times, consider shifting some allocation from aggressive segments to large cap or flexi cap funds for more stability. Sixth, maintain a liquid buffer for peace of mind. Keep 6 to 12 months of expenses safe. Seventh, ignore the noise and focus on the process. Turn off anxious news. Review your portfolio quarterly, not daily. Compounding works in silence. Here is what you can do this week. Step 1. Do not stop your existing systematic plans. This is the most critical action. Step 2. Within 1 to 3 months, contact your distributor for a portfolio health check. Ask them to review your asset allocation and identify any need for rebalancing. Step 3. For any new money, use a systematic transfer plan from a liquid fund. Dada's wisdom of the day: managing market volatility is not about predicting storms, but about building a board that can weather any storm. Your systematic plan is the hull, your asset allocation is the ballast, and your trusted guide is the experienced captain. I'm genuinely proud of you for asking this. It shows you're thinking like a seasoned investor. This disciplined approach builds generational wealth. Stay the course. Remember, investment in the equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Past performance is not indicative of future results. Dada's action plan for you. Step 1. This week, do not stop your existing SIPs. This is the most critical action. Volatility is the entry fee for long-term returns. Step 2. 1 to 3 months, contact your MFD for a portfolio health check. Ask them to 1. Review your current asset allocation versus your goal. 2. Identify any need for rebalancing, profit booking in overheated segments. 3. Ensure your emergency fund is intact. Step 3. Ongoing discipline. If you have new money to invest, use an STP. Park lump sum in a liquid fund and set up a 6 to 12 month transfer into your chosen equity funds. Dada wisdom of the day: managing market volatility is not about predicting storms, but about building a board that can weather any storm. Your SEEP is the hull, your asset allocation is the ballast, and your trusted MFD is the experienced captain guiding you to the shore. Let the waves of volatility wash against you. They cannot sink a well-built ship. I'm genuinely proud of you for asking this question. It shows you're thinking like a seasoned investor, not a speculator. This disciplined approach is what builds generational wealth. Stay the course, trust the process, and remember your Dada is always here to guide you. Dada provides educational wisdom and guidance. Always consult your registered financial professional before implementation. Investment in equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Thanks and regards. Cost of Bishwas, www.planfuture.in